2, here we are in Chapter 2, Part 2. We're going to start to get into financial statement analysis. Again, my name is John Alpers. I'm a faculty member here at Tennessee Wesleyan, and this is Part 2 of Chapter 2. We're going to start to get into our ratio analysis. In Part 1, we talked about the different financial statements that are used, and we talked about the ones and what they do. Now we're going to get into what ratio, what analysis can I do based on the financial statements that were presented earlier. Okay, the ratios are extremely important, and when we ask you to do analysis on organizations, you need to do some ratio analysis, some of which are very, very easy to do, but will also tell a really important story about the organization. A couple things you got to be careful for careful about when you're dealing with ratio analysis. Never, ever look at one ratio and try and make a decision about an organization. You should look at trends of ratios and trends of analysis. When you look at one organization for one period of time for one ratio, any one individual item, you can have skewed or biased information that can come out. So make sure that you are looking at trending of information. So if you are asked to do an analysis of the industry versus the organization, don't just look at one period. Make sure you're looking at multiple periods so that you can get a truer, cleaner, more accurate picture of what the organization is doing. Okay? The purpose of the ratio analysis is to standardize things, because in Part 1 we talked a little bit about the fact that if I'm dealing with big, huge Mongo organization versus a little small, relatively mom and pop type organization, if I look at the actual numbers, it can make one look a lot bigger, a lot smaller than another one. Well, that might skew what you're actually trying to say about that organization. So what it does is it equals them all out, and then I can talk about what some of these ratios are, and it evens out whether or not it's a big organization, small organization, and it's still somewhat based on industry, but now I can start to give better and more accurate advice to these things. It's used to highlight weaknesses and strengths. It is an indicator of health. Okay. The different types of ratios that we are going to use are going to be liquidity, asset management, and debt management. Okay? There's also profitability and market values, all of which are used to do different things. For example, liquidity. Liquidity from a definition standpoint means the ability to be able to pay your bills. So the more liquid you are, the more you're able to pay your bills. Now, that doesn't necessarily mean it's good, because if I have too much money that I'm holding on to, the question would be, why are you holding on to so much money? Why aren't you using it for something? Or why aren't you paying down your debt? There's no reason to pay interest on something if I'm just holding on to money. Okay? Asset management. Am I using the assets that were given to me effectively and efficiently? Debt. Do I have too much debt? How am I financing the activities of this organization? Profitability. How profitable is the organization? Okay, and market values. How do you gauge this organization versus other places compared to the market? So the liquidity ratios basically are two. You've got your current and your quick. The current is current assets over current liabilities. Okay, current assets over current liabilities, and it's an indicator that says are you able to pay your debts and by how much. Now in this case, they look at the industry average, and you look at what this Unilate can actually do. Unilate is 3.6 to 4.1. The answer, and the question would come, is this good or bad? Well, the answer is it depends, because if you had 3 times the current assets to pay your debt, almost 3.5 times, you'd say, that's good. There's nothing wrong with that. Where it becomes a negative is everybody else in your industry can do it 4 times. So even though you're good, you're not as good as the industry. The problem with this comes in is when I define current assets, some of the things that are included in current assets might not be as current as what they really are. Things like, for example, the main thing is inventory. Inventory isn't necessarily, could take some time, and organizations will occasionally, in order to make this ratio look better, buy a whole bunch of inventory. Well, that might not be in the best interest of the organization, but if they've got ratios that stockholders or that bond covenants are making them adhere to, they might do that in order to increase this number. The way we handle that is by doing the quick ratio, which takes the inventories out. Now, when we look at Unilates, we've got a situation. Unilate is 1.5. When we take the inventory out, okay, inventory is more than half their total assets. From an analyst standpoint, you go, man, that's a lot of inventory that you've got there as a percent of your total assets. So when we look at that, you take it out, they went from what we had before, 3.6 to 1.5. The problem that I see with this organization is that it's still below the industry average. So from a liquidity standpoint, you're okay, Unilate. You're okay from that, but you're not as good as the industry. Okay? And it looks like it's fairly poor compared to the industry. Now, when they say fairly poor, that's extremely subjective, because there are other organizations that would love to have a 1.5 in their quick asset. Love to have that. Okay, so it's very subjective and very dependent on what organization you're dealing with. Asset management ratios, those are the ones that we will use. What they basically deal with, inventory turnover has to do with how quick are you turning your inventory, how quick are you selling your inventory. What you don't want to see there is your days start to grow. Again, why would you not want to look at one particular month? If I told you that that number was 38, would that tell you that it's increasing, decreasing? What is the movement related to that? You don't know. So what we would have to do is we would have to make sure that we knew what the trend of that information was. Days sales outstanding, that's more of a measurement of accounts receivable, because what I want is I know how I'm selling things, but I want to know how long it's taken me to collect them. How long does it take to collect them? The bigger that number gets, that means I've got more money tied up in accounts receivable. Fixed asset turnover and total asset turnover has to do with how many times I'm making, how many times I'm earning those monies. We'll show you the exact math in just a sec. There's your inventory turnover, cost of goods over inventory. Again, Unilate is 4.6, industry average is 7.4. So not only are they not very liquid, it doesn't look like they're very efficient in the way they're using some of their assets. Days sales outstanding. Days sales outstanding, Unilate has 43.2 compared to 32.1. So what happens here is more of their sales are outstanding. They're not collecting their sales. Turnover. The industry is 4 times compared to Unilate's of 3.9. Sales over fixed assets. So my sales are not as good compared to my fixed assets as the industry. It's close. It's close, but what this is it's building a bigger case to say, is Unilate has some problems compared to the industry? Appears like there's all indications that they do. Last one, sales over total assets. We start to see it grow a little bit. We start to see this grow over over what we had before, which was the fixed asset portion of it. Okay? In total, what this tells us is that all of our turnover ratios are below the average. That means they're not using their assets as efficiently as what the rest of the industry is using. Debt management ratios are, as you see, what this has to do, the debt ratio has to do with how much are you financed by debt. Times interest earned has to do, you're earning the interest that you pay, the interest that you're paying on the debt, how many times are you earning that? The more times you're earning that is usually an indicator that you can take on more debt. Last one is fixed charge coverage. All of the fixed charges that you have, how many times are you earning that? The more you can cover that, obviously the more fixed charges you can take on. So, debt ratio. Liabilities over total assets. How much debt do you have? How much is being financed by debt? The answer here, or the question that would come up would be, is that good or bad? And it's very, very relative. In this case, Unilate is not as good as the industry average, which means the industry average has, on the other side of it, that means there's 58% is being financed by equity. Now, it's not necessarily good or bad to be financed by debt or equity. It is typically more expensive to be more debt than equity. because there's interest you have to pay on the debt, whereas on the equity you don't have to pay interest. You do have to pay dividends out to them, but it's not a set amount. You cannot go bankrupt by not paying your shareholders. You can go bankrupt by not paying your debtors. So usually the indicator of a higher debt means that there's more expenses related to that. Next, times interest earned. The industry is earning more than twice, they're earning their interest more than twice what Unilate is. This tells me that they can't take on any more debt. The other indicator should have told us that as well, but this is just feeding more fuel to the fire that Unilate's in a little bit of trouble. Last is the fixed charge coverage is the earnings before interest and taxes plus your lease payments, your set payments over interest charges, lease payments, and any sinking fund. Definition of sinking fund is if there's any fund that you have to cover due to debt restrictions or due to pension restrictions that basically say you need to have so much money held in an account. That account is referred to as a sinking fund. So anytime you have to hold money out for whatever reason, they call those sinking funds. So in this case, we're 2.2 to 5.8. So are they covering their charges, their fixed charges as well? Not even close. Not even close. So probably will find it difficult to borrow additional funds because they're not covering it as much as the industry is. So banks are going to charge them a higher rate in order to get any more additional or any more debt whatsoever. Okay, profitability ratios. Profitability ratios have to do with how profitable is your organization. Net profit margin is how much the sales less your expenses. Total return is what are you earning on the assets that you have been given to use. And return on common equity is what are your owners earning? What are your owners earning? The actual math related to it is net profit over sales. Profit over sales will give you what this is. Okay, again, are we to the industry average? No. Next is return on assets, which is net income over total assets. Net income is your actual, it's the end of the result of your income statement. So this says that I'm earning 6.4%. But on average, the industry is earning almost double that. Not quite, but almost double that. It's a big enough difference where it would be problematic. Next, return on common equity. Okay, again, are we to the industry average? Here we've got our net income over our common equity. Are we to the industry average? No. But these are all indicators that you should use, and you should use as many as you can in order to tell the story of the organization that you're talking about, in order to say they've got some issues as far as their debt. They've got, they're not to the industry average. This is below, this is above. You want to be able to say with some conviction what you think is going on with the organization. Okay, so what we're showing from this is Unilate's got some problems. They're almost everything is below the industry, so they've got a lot of things that they need to look at. The last is market value. Market value is PE ratios, price earning ratios, and market to book ratios. PE ratios have gotten a lot of play in the media, and a lot of people are talking about those. In my personal opinion, they're a little bit overstated because price over earnings, which means the more that people are paying for your individual earnings. Individual startup organizations could have PE ratios in the 400s. Does that necessarily mean they're a lot better than somebody else? Not necessarily. You need to look, again, at the trend of what these things are doing, and you need to look at the history. You need to look at if things peaked or if things are diving, why they are. Okay? To have a price earnings ratio from an entire stock standpoint, from an entire stock exchange standpoint, they used to say that they wanted things to be in the 5 or 6 range from a PE ratio, which means the price of all of the stocks compared to the earnings of all of the organizations should be about 5 or 6. Well, in 2007 and 2008, when there was the huge crash that occurred, it was trading right around 20 to 30. So the higher it gets, usually they refer to as there being a correction in the market. The market will actually say, no, that price is too high compared to the earnings that are supporting it, so the price has to come down. Well, the price comes down, obviously that means the price of the stock goes down. The people who paid this are going to lose money. are going to lose money based on that. So PE ratio, I think you have to look at it relative to some of these other ratios that we looked at. It is a good investment tool. It's not the only investment tool that's used. So use some caution when you use that. So here's the math. Price per share over the earnings per share. Very easy to figure out. Here, Unilade again is not to the industry average, is not trading to the industry average. Last is market to book ratio. And this has to do with how much the market price of the stock is compared to the book value per share. Now, the issue with this ratio is these things are somewhat subjective in their calculations. They shouldn't be, but they are. I mean, they should be fairly set, but in order to get to those numbers, if you have subjective numbers in these, you're going to have subjective information that comes out. You can get the same information by using the PE ratio, essentially. Okay? So, investors are not excited about the future prospects of this organization. Well, again, they looked at one period of time. They looked for one group of financials. Now, granted, everything told them that this thing had some issues. Everything said that Unilade had some problems. But does that mean Unilade is necessarily going to close up business, they're going to go bankrupt? Not necessarily. Not necessarily. I would want to see where they were a year ago, 6 months ago, and I'd want to see maybe current. I'd want to get some more information before I made too big of a conclusion on this. So the other thing that we'll look at is the DuPont analysis. DuPont analysis is another way to look at the return on assets. In this case, 6.4% versus 13. Okay. It will give you another way to look at the firm's profitability. It also incorporates the expense control and asset utilization, which is why the DuPont equation is used. It is a valuable tool. Some organizations use it a lot. A lot of the organizations I personally dealt with did not use it, but it is a good tool to be able to differentiate and tell about the relative worth and merit of an organization. So, limitations with all of these financial statement analysis is inflation distorts balance sheets. So if I look at something that was 10 years old, I'm going to see big, huge increases that have nothing to do with the organization. It has everything to do with the fact that prices went up. Prices of everything went up. Okay, window dressing can make ratios look better, and I'll give you an example of this. I worked for an organization once that had bond covenants, debt covenants that we had to meet in order to be able to keep our debt, or what they would do is they'd say, you got to pay your debt off right away. Well, one of the bond covenants was that we had to have a certain amount of cash on hand. So for the last month of our fiscal year, one entire month, we paid no bills, 0 bills. Grew this huge cash balance. I mean, we paid for electricity and we paid our employees, but everything that we could hold off on for an entire 30 days didn't get paid. We did not make many friends with our vendors. We did not make many friends with the people we were doing business with, but we met a bond covenant. We window dressed the financial statements to make them look better. Now, the other related aspect to this is if you're not paying your bills, your accounts payable is going through the roof. But in that case, it didn't matter because the bond covenant didn't have any impact on accounts payable. It was just cash balance. We had to have a certain number in cash. So, financial statements can be window dressed, if you will, to make them look a little bit better. Okay, hard to tell if a ratio is good or bad. Remember what I said about the good or bad ratios. Everything is relative. Everything is relative either on the prior period or the industry or the combination of both. Numbers that could look to be good. When we looked at Unilade's liquidity position, they're able to pay their bills. That's not a bad thing. They're just not as good as their industry. So be very careful when you say good or bad. You can say not in comparison to something else, it's not as strong as this. I would really try and shy away from good, bad. Value judgments usually don't work with this. Okay? Difficult to tell how strong or weak a position a company is because there's window dressing going on. Look at the example I just used with that organization that didn't pay bills for a month. They made their cash look like they had a ton of cash, but we didn't pay bills for an entire month. So you really have to make sure that you read all of the financial statements, make sure that you understand it, and look at more than one period of time. This is the end of our chapter.